A modern corporation is a system of constant, chaotic motion. Cash flows out, inventory ships, machinery degrades, and debt accrues. But to analyze the actual health of that system, the motion has to stop entirely. The statement of financial position, commonly known as the balance sheet, forces this pause. It reports the precise amounts of a company's assets, liabilities, and equity, locking them in at a singular moment in time, typically the end of the fiscal year. Isolating these figures allow analysts to measure the firm's immediate liquidity, calculate how efficiently it deploys its assets, and evaluate the risk inherent in its capital structure. The underlying logic for this document relies on what is known as the fund theory. This framework compares the entity's active resources against the amounts contributed to acquire them, specifically the capital provided by creditors and the capital provided by investors. This comparison creates a strict mathematical equilibrium. The resources, or assets, must perfectly equal the claims against them, liabilities plus stockholders' equity. By rearranging this equation, we arrive at the proprietary theory, which isolates the exact value held by the owners. When you deduct the economic obligations, the liabilities, from the total economic resources, the resulting residual is the equity. It is the net worth belonging to the shareholders. This basic accounting equation dictates the recording of every single economic event within a corporation. If a financial transaction occurs, the math must balance. Because the accounting equation is absolute, every financial transaction operates under the rule of dual effect. A single action must impact at least two elements of the equation to ensure the total scale remains level. Looking at this transaction flow, we see the dual effect during a standard revenue event. When a company receives cash for a service, an asset increases. To offset this, the right side grows, as equity increases directly through service revenue. Debt-driven transactions follow the exact same mechanical constraint. Purchasing inventory on account raises total assets, while simultaneously raising accounts payable, a liability. When the company later pays that supplier, cash decreases and the liability drops by the exact same amount. The equation can also balance internally on a single side. If a firm purchases equipment with cash, one asset decreases while another asset increases. The total sum of the left side remains identical, and the capital structure on the right is completely unaffected. Over a fiscal year, a major corporation will execute millions of these localized dual-entry microtransactions. Aggregating all of them generates the final numbers reported on the Statement of Financial Position, ensuring the macro-level document is structurally flawless. A raw total of assets tells an analyst almost nothing about operational survival. To evaluate short-term viability, those resources must be structurally classified. This standard taxonomy categorizes resources by a critical division, the threshold for current assets. An item qualifies as current if the company expects to convert it to cash, sell it, or consume it within 1 year. This block captures cash, receivables, inventories, and prepaid expenses. Under United States reporting standards, these current assets are rigidly ordered by liquidity. The resources closest to becoming actual spendable cash sit at the very top. Items failing that 1-year test fall into non-current assets. This captures long-term investments, property, plant and equipment, often called PPE, and intangible assets like patents. While U.S. filings prioritize liquidity, some international standards mandate the reverse. They use a production order, placing massive, illiquid items like real estate and heavy machinery at the very top of the balance sheet. By structuring the U.S. balance sheet strictly around the speed of cash conversion, analysts can rapidly verify if a firm has the immediate resources required to keep its front doors open. Knowing how quickly assets convert to cash is only useful if you know exactly when cash needs to leave the firm. Focusing on the right column, the liability side, tracks impending outflows. Current liabilities are debts that must be settled within 1 year. These represent routine operational burdens, accounts payable, accrued wages, and the current portion of long-term debt coming due. Non-current liabilities map out the firm's long-term capital strategy. Bonds payable, complex lease obligations, and deferred tax liabilities belong here, as they do not demand immediate settlement. There is a specific reporting exception for debt. A short-term obligation can be removed from current liabilities if the company demonstrates both the formal intent and the documented ability to refinance it on a long-term basis. Aligning the liquidity timeline of the assets directly against this maturity timeline of the liabilities maps out a firm's margin for error. It is the definitive test of financial flexibility and risk. The final piece of the capital structure is equity. It is crucial to recognize that equity is not a reserve of cash. It is strictly the residual ownership interest remaining after subtracting all liabilities. To track how that residual value was generated, the total equity block is divided into specific subcomponents. Capital contributions represent the direct funding from owners. This splits into the technical par value of the issued stock and the additional paid-in capital, the premium investors paid over par when shares were sold. The largest source of value for mature companies is usually retained earnings. This represents the accumulated net income the firm has generated over its lifetime that has not been distributed as dividends. Corporate boards routinely restrict these earnings, keeping the capital inside the business to fund future expansion. When a firm uses its resources to buy back its own shares on the open market, it creates treasury stock. Treasury stock functions as a contra account. Because the company is returning capital to exiting shareholders, this account carries a negative balance, mathematically shrinking the total equity stock. Accumulated other comprehensive income acts as a capture point for specific financial gains and losses that accounting rules dictate must bypass standard net income. Equity is an ongoing historical record of owner contributions and retained corporate wealth. It provides the exact mathematical residual needed to perfectly cap the accounting equation. The assembled statement of financial position is a highly precise mechanism for tracking resources and obligations. But equating this perfectly balanced technical document with a company's true market value is a severe analytical trap. The strict rules of accounting often divorce the balance sheet from open market realities. Many large items, particularly property, plant, and equipment, are recorded strictly at their historical cost. A manufacturing facility bought decades ago remains anchored to its original purchase price on the balance sheet, completely ignoring any appreciation in current market value. Despite the rigid mathematical framework, building the document requires continuous management estimates. From predicting bad debt to calculating depreciation, human judgment introduces inherent subjectivity into the final totals. Most significantly, the balance sheet ignores major drivers of modern corporate value. A firm's proprietary knowledge, its workforce talent, and the strength of its brand generate massive revenue, yet because they cannot be objectively quantified, they are omitted from the document entirely. The statement of financial position maps out the precise mechanics of a firm's capital structure and its immediate liquidity. It tells you exactly how the machine is built, but it does not tell you what the market will pay for it.